Hey everybody, we're with David Keller. David Keller's from Stock Charts. I definitely have been following his stuff from a long time. He runs the Mindful Investor. You could check out his stuff on Stock Charts every day. He's on there all the time. I get to catch up with him a lot, like watching his research and so on. His Twitter handle is dkellercmt, so definitely check him out on Twitter. He's always posting amazing charts, amazing research. I love his channel. I love the way he looks at markets, and it's a blast to actually get you on here and talk to you. So how are you doing today, David?
I'm good. It's good to chat with you, Jason.
Good, good. Yeah, we just found out that David actually is from a similar area to me, so that's super cool. It's always fun to kind of catch up with somebody from a similar area and kind of just know that, like, different paths led to markets, like how exactly did we get here. So I have to ask you to start out, how'd you end up here? How'd you end up in markets? How'd you end up as a technician?
Right. So I grew up in the Cleveland area, as did you, Jason, and I went to Ohio State, where I met my future wife, and I studied music and psychology. So I have what I would call a non-traditional path into the financial industry. Somehow the music and psych degrees, I think, uniquely prepared me for a successful career in the financial industry, particularly because of my focus on investor sentiment and psychology. So it's been really, really helpful. But long story short, at the end of studying those topics, and particularly music as an undergrad, I was ready to avoid the cyclical income stream of a musician and look for something a little more consistent. And I looked for companies that would pay me and would teach me how to do something that people would pay me to do. And I found a firm called Bloomberg in New York. And I remember interviewing there. I remember getting on the plane back to Columbus and thinking, that if I get the opportunity, that's it. Like, I've got to go there. And what was really cool is they would hire about 50% liberal arts majors, 50% finance and econ majors, put us all in a room together for 6 weeks. And I found that the finance majors would help me understand what a stock is, how to calculate bond yields, what the Fed's role is, all of that. And I would teach them how to ask questions, how to present topics, how to listen, and how to be a good communicator. And in the end, we all came out a little, pretty well rounded. And then, long story short, as I started working at Bloomberg, I quickly discovered technical analysis, which, from my experience, was a way to quantify what investors were feeling and thinking, and how that was reflected in stock prices. And when I realized that there was a toolkit to help get inside the head of other investors and understand the sentiment of the markets, I was completely hooked, and I've kind of ridden it from there, I guess.
Very cool. I we were talking earlier, like I love that path that you talk about, because for me, I really believe, I mean, I always talk about it. If I had my choice of job and I didn't have any sort of need for income, I would definitely enjoy studying group psychology, because to me but that's the markets too, so
Yeah.
it's not exactly like I don't do that. Like, well, that's what we really do. And charts are really kind of a way to kind of tell what the group is doing, what the group is thinking, as opposed to what people are saying, and I
Yeah.
think that's the beauty of the charts, is that you could listen to Bloomberg all day. You could listen to people talk all day, and you don't know if they're speaking their book. You don't know if they're speaking their research, their system, whatever.
Yeah.
But you do know that if the price is going up, where people are actually buying, what people are actually doing. You could look at volume, you could read the momentum, you can read the tea leaves basically, and kind of get an understanding of where markets are going. And
Yeah.
that's through the psychology of all the market participants. And I think that's what a lot of people, when I have conversations about technical analysis, I have a few friends who are heavily fundamental, and they discount technical analysis completely, even though they all use it. They'll be like, oh yes, that's right at the two, like they're talking about Bitcoin the other day, and they were like, it's right at the 200-day moving average. I'm like, what are you talking about? You just made fun of me last week for bringing up something about a moving average. Now you're
I always joke that the market is full of closet technicians. And I will tell you, I mean, I've spent years working with institutional money managers and brokers and traders. And I can't tell you how many times I would be in someone's office. And the first time it happened, I thought it was hilarious. Like, he kind of sheepishly looked at his door and then reached and opened this drawer, and he had point and figure charts that he had been keeping by hand for years. I'm like, of course you are.
gotcha.
But so many people will swear that they are very fundamentally oriented. They will swear that it's all about the macroeconomic picture and geopolitical events. At the end of the day, the market doesn't, I strongly believe the market doesn't move because of inflation or because of PE ratios or what the Fed's doing. It's what people expect about earnings and what they expect about inflation. It's all about expectations. And if we have a toolkit that can help us quantify those expectations and recognize when investors are getting excited or nervous or panicked or euphoric, I would say the charts reflect that brilliantly. So analyzing the markets, analyzing price action really helps you understand what investors are excited about, what they're nervous about, because the price reflects that. That's what John Murphy, wrote in the first book I ever read on technical analysis, and that's been my experience every day I've been using it.
Yeah, absolutely. That's well said. And I always talk about the fact that I would meet people, especially in trend following. You got people who are CTAs, for example, and they'll hire somebody. Basically, they'll have a long signal for something like coffee, and they'll call somebody and be like, "That's a coffee trader or something," and be like, "Hey, can you write me a bullish thesis on coffee?" And then that's what they put out to their investors. And it's like basically they just hit 100-day high in coffee. And instead of like just saying, "Hey, we hit a 100-day high in coffee and our system is long," they're going to say, "Oh, well, these fundamentals from this area and this thing." And people love stories, and that's the thing I think we also struggle with in that space, is coming up with stories for why these things work, because really there is huge, amazing stories. I think someone who did it well, Mike Cavell, wrote a bunch about that sort of thing. There are stories for how these things work and how they happen, but it's very hard to articulate, because I think the people that are really drawn into that type of systematic trading are the same people who really don't care about stories. They write it. They're not. I mean, that's also me as well. I also suffer from that. So there are stories there. There is something to pull out of it, but most of the time I'm just like, "The system's long. Shut up."
Yeah.
Like the system.
I remember talking with John Bollinger years ago about just that issue of the gap between the narrative and the numbers. And I think a lot of, particularly hedge fund analysts and managers, a lot of times, and quantitative analysts focus on the mathematical nature of the markets, and they think of it as this mathematical equation. If they can just solve it and create this model that helps reflect what these numbers are doing, then they've figured it out. But at the end of the day, I mean, what he and I talk about, what I truly believe is that the numbers that are reflected in the charts tell a story. And I've always thought of charts as a way of recognizing how that narrative is evolving. It's not just numbers on your screen. They're not just levels. They're not just green and red lines that cross or whatever toolkit you use. It reflects investor behavior. You're quantifying actions that individual investors and big institutions are taking every moment. So I would argue that the growth in behavioral finance, and really, what Kahneman and Tversky and many others have built on, sort of categorizes different behavioral biases, why we are irrational and why we make poor decisions. And I think charts, if you think about what charts are reflecting, it's those behavioral biases that impact all of our decision making. And it just gives you a toolkit to quantify those and understand those. So I think there's a narrative there. I think if you think of the markets as a bunch of numbers, you're missing the human element, which is arguably what makes the financial markets what they are.
Absolutely, and we know what irrational looks like. We know what that looks like. If you read the charts all the time, you know what that looks like, and there's a shape to it, there's a size to it, and I think that's something that I don't personally articulate enough. And that's something that is so important, because that's the reason why. I have a good friend of mine that was talking the other day about us being wishy-washy, because the data of, let's say, like a Head and Shoulders breakdown, and if it goes the other way, we're like, "Oh, it's a failed pattern, it's great." Like, to me, that says so much about the market, more about the market almost than a good Head and Shoulders pattern just breaking down. And I see the story in that more than I see, and also the ability to read the charts and really be able to switch your mind, like switch what you're thinking very quickly, because it's important to understand that in any form of trading, whether you're fundamental or whatever, when there's new information, you have to change your mind. That Keynes said that, or something, like that's something that's very important, is that you see this information, you see this breakdown, you see that pattern of maybe people got a little bit too panicked. For example, the other day, You know, who knows if Friday was a little too panicked for what actually happened. But the charts right now are kind of saying that. They're kind of saying, hey, that was a little too much. Like, we didn't really need to get that oversold on every single asset. You know, we're bouncing now. You know, maybe the bonds went a little too far. You know, this is what the charts are saying at the moment. So it's interesting to kind of talk through that story with you. And I guess the one thing is, what do you think is a good historical reference for somebody to look at and go, hey, that was a point where the market was so irrational, so crazy, and the
Yeah.
chart were telling a story.
Well, it's funny. I mean, you mentioned sort of narratives, and I think, having a good narrative for what's happening, the purpose of that is usually for us to feel better about what's going on, right? We want to feel that we understand what's happening. And the reality is the markets a lot of times are moving despite what we think should happen or could happen. They're just evolving because it's a bunch of buyers and sellers coming together. So the problem with having a good narrative is what's called the narrative bias, which is once you've created this sort of pristine narrative in your head, and that's what's happening, when the chart tells you something different, you resist that because you're still tied to that narrative. And I think, to your point, I think one of the great benefits of using charts consistently is it allows you to be nimble. It basically, the chart tells you, it's your report card. It tells you when the narrative's no longer working, and forget what you think could happen or should happen. The market's changing, right? Bitcoin went down to 20,000 and then it turned quickly and went above 25,000 in a couple of days. Like, that happened. It doesn't matter what should happen or what that might mean. It moved. So you have to respect the fluctuations in the market, and that it reflects changing sentiment and changing supply and demand. So, what I would say is that what's unique about right now is you think about sort of this mini financial crisis for now that we're sort of seeing limited scope, but potential to be bigger. Who knows what will happen? I mean, it started with a couple banks going under, and for now it seems to be alleviated. We have the Fed coming up soon, a lot of more information that can come of it. So while this particular exact moment has not really happened before like this, there have been plenty of financial crises, right? There's one that was not too long ago, 15 years ago. We can look at some pretty good evidence of what happened going into, a bank panic and sort of a mini run on certain banks. What happened when a bank went under, how, what led coming out of that. And besides that, there have been plenty of crashes, right? The whole boom and bust phenomenon has been going on for centuries, right? You can go back to classic examples like tulip mania or the South Sea bubble to see when people get super excited and get way over the front of the skis excited about a particular idea. And then it runs out. And the other thing, right, that panics have happened, right? People get nervous, and then there's panic selling, and there's a feedback loop, and things go down. So I think one of the great benefits of technical analysis is it's a history lesson for the markets, right? While what happens today is, always a unique combination of circumstances, markets have rallied excessively, and they have sold off aggressively innumerable times, right? And so we can go back and look at what indicators helped us understand and quantify that move, help us identify when a bottom was in, and helped us understand the recovery phase. And so I would encourage people to look back on the charts at previous pullbacks and previous drawdowns and see what recoveries looked like, and just think about what that can tell us about a likely scenario going forward.
Yes, and yeah, I think the best thing that you mentioned in that I can kind of pull out, which is the history of the markets. Like, that's the big lesson that you said in everything that you just said, because we can go back and we can kind of look, and for me, that's the biggest thing. When I first learned about trading, I had a great uncle that was a trader, and that's all he really did, was go back and kind of look through these panics, this history. He would always talk about wheat data. We got wheat data till whenever, as we can go all the way back to Egypt, and I'd be like, you're crazy. Why are you going all the way back to Egypt? Now I go all the way back to Egypt for wheat data. But once again, it sounds crazy when you're first hearing about this stuff, but really I can tell you about all these panics, all these wars that have happened, all these things that have happened over history. Interest rates, we got a ton of interest rates history. So you can kind of see what interest rates do during certain times, what they do during war times, what they do during a time just like this. Like, the only time we really had something, and the market, and you also learn that the real thing that panics the markets is the uncertainty.
Mm,
not, a specific event. If we had shutdowns again and again, and we knew the outcome of the shutdown would just mean people would use Amazon, Apple, and so on a little bit more, the market could have went up during a shutdown. As
yeah.
crazy as that sounds, that's completely possible. But because it was so much uncertainty, so you kind of learn to understand that there's the charts that tell you what they tell you, and then there's also his history that tells you that the markets hate uncertainty, and then you
Yeah.
put this together, and then you're kind of going, oh, well, this is where we're at here. It's kind
Yep.
of, I think the best lesson we all got in charts and markets was COVID. You had the crash.
Mm,
Basically, that was a lot of that happened before the shutdowns, before anything really crazy was happening. Like, yes, that we shut down, I think, right into the bottom,
yeah.
but we bottomed when we were shut down,
That's
and
right.
continued to rally off of it. And everybody, bear market rally, relief rally, whatever you wanted to call it, but it was telling you something.
Yeah.
And once we got to basically around those highs, I think it was June, now we're kind of looking at a real change in the markets, and it's like, yes, the economy was crap. It's kind of like today, right now, everybody's going, there's a recession, the markets can't go up. There's a recession, the markets can't go up. And it's like, the markets can go up whenever the hell they want to. It just
That's
depends.
right.
It just depends on what exactly are we looking at this moment. Are we looking
Yes.
at uncertainty? Are we looking at, is it discounted at the moment? Is it
Yeah.
not? And once again, it's a constantly reassessing it. Today I have an opinion, tomorrow that opinion could change, but today I have an opinion on that.
I always tell people it's about your market awareness is what I call it, and it comes from flying. So I'm a student pilot, and when you learn to fly airplanes, they teach you about situational awareness, which is where are you at relative to your surroundings, right? What is the plane telling you about the conditions? Can you look, out of the dashboard and the windshield, and look for traffic, look for obstacles, look for weather conditions, and all of that. And really bad things happen as a pilot if you don't have a good situational awareness. And most accidents for private pilots are human error. I mean, by far, it's over 90% are caused by human error. The number one cause is you run out of fuel within a couple nautical miles of your home airport. So to be clear, the plane tells you you don't have enough fuel, but you think, I bet I can get it back to the airfield and land safely. Of course, the plane is not making it up. It's not a judgment call. It's like it's out of fuel. So you ignore clear evidence. And I find with a lot of times with investors, we don't have a good situational awareness of what's going on around us. So a lot of the people I work with, it's all about routines. How are you spending your time? What are you looking at first thing in the morning? How are you starting your day as a trader, as an investor? What's your process every day, every week, every month to reflect on what's new, on what's different? And it's not enough, I don't think, to just look at the chart of the S&P or soybeans or Ethereum and say, here's what it's telling me right now. The real value of analyzing the markets is by doing the same thing consistently. Look at that chart every day for a year, and then you can tell me you have a good sense of what's happening with that particular chart. So I would encourage people, watching and listening, to think about what your routine is. I always call it your morning coffee routine, right? First thing in the morning, you get your coffee, you sit down. What are you doing? And a lot of times, people that don't have a good feel for the markets at any given point have avoided that sort of routine, that process, that consistent process of analyzing the markets. And one final thing, I always tell people that an imperfect but consistent routine is way better than a perfect but inconsistent routine. Go for consistency first, get in a habit of doing it the same time, the same day, and then start improving the process that you're doing. And I think that's a really good starting point.
No, that's true, and that's everything in life. Like, really,
Mm,
you want to be at a high level in anything in life. Whether it's flying, like I used to ride BMX bikes, like whatever it is,
yeah.
you have to have that routine that gets you into your zone every day.
Yep.
And it's very easy to get out of it, especially when things are good. Like,
Yeah.
things get really good, and you're like, especially in markets, you're performing really well, you're doing really, and then you're like, why am I even looking at any of this? Like, I'm doing so good. I can't believe I even look at this. I know everything, and and not to mention, you see it kind of in when the bulls get too loud or the bears get too loud. It's a
Yep.
situation where it's not that they're going through the routine. They'd rather be out there telling you about how great they're doing than really just focusing on what they're doing.
That's
Uh,
right.
for me, I always try to, number one, I always try to stay very humble because I know that the markets can humble me at any moment. They've done it many times. They will do it many times again. You know, like I have good performance, but that doesn't mean that will go on forever. You know,
That's
so
right.
I have to really keep that in my head at all times. And then, like you said, like, and I'm sure I got that probably from you. I used to watch stock charts all the time. So I'd watch
Yeah.
everything all the time. It'd be up here all the time, all day long. So I'm pretty sure I got that routine from you because I have one too, you know, that I go through every single day. And it's very true because you can't really, okay. So if you're looking at a chart and you're looking at it and thinking about like the future, it's all blank, you
Yeah.
know, like, and I like to put a lot of space on the end of the chart for me to kind of speculate on that from time to time.
Yeah.
And looking at those things in the future, you have to kind of come up with an understanding of it over time. Like you said,
Mhm.
like looking at it year after year, day after day, that what does this bar mean? Like, what does this bar mean? And so on. And a lot of different products are very different. You know, like
Mm.
I trade a lot of commodities. So trading commodities, I know that if I buy on, like, for example, the S&P 500, if I buy on 4 days down, historically I'm actually going to make money just buying and holding for a day or two. If I
Yeah.
buy it 4 days down on something like coffee, historically I'm going to lose everything.
Yep.
You know, very, very easily. So you start to understand that, okay, there's different asset classes, they behave differently in different ways, and the only way you do that is over time and really researching and learning.
That's right. And I always tell people to learn the lessons of the markets, right? So the chart, what's great about the charts, one of my former analysts at Fidelity used to call the charts are the truth serum for the markets. So it tells you what is actually played out. And there's so much you can learn. You have this capability with a chart to backdate it and just look, all right, what did this look like? And so when we're in a situation like we are now, which is potentially a significant low for stocks was put in October of last year, we've now rallied off of that level, but still pretty uncertain, right? We're still in a rate hike cycle. It's, you know, with an undetermined end. So we don't know exactly what's going to come out, but we can look back and see what has happened at historical bottoms, right? And look at the chart and what indicators suggested things were rotating and which ones might have been an early warning or a leading indicator that something was starting to happen. And then which were more confirmational that said, all right, while it wasn't the perfect, you know, moment to buy, it confirmed that the trend was now reversed. And so I would encourage you, we spend so much of our time focused on the now, right? And what's going to happen next. And that's great. I mean, that's probably where our head should be at first. But you mentioned earlier sort of learning the lessons of market history. What I learned from working with really successful investors, it's not just about knowing what's happening now. It's reading books about the 1960s, right? The go-go years, which were a, you know, raging bull market phase. Go back to the banking crisis of 1907. Read books about what happened in a financial crisis over 100 years ago, how they detected it, what they did to correct it, what happened to investors during that period. You know, even more recently, look at, you know, there's a book called Bull, which just talks about like 1982 to like early 2000s.
Yes.
What did that bull market phase look like, right? What were people talking about and thinking about in the 80s and 90s as things were growing? So even if you weren't investing in 1995, you can learn a lot about what the conditions were like and what people were thinking. And you will find, if you read those books, you will hear the same language, the same ideas will pop up, and you will immediately think, we're in 1995. Like, that's what I just heard. That's exactly what they were saying. And I think learning those lessons can be real. If you have the capability with charts and with reading some of the more timeless writings about the financial markets, you have a really good opportunity to learn the lessons that others probably are not taking the time to do.
Yeah, and you know, books in general, and the lessons of it are so important because I think there's a couple things. A misconception of traders that you're a trader, therefore you make money every day or every month or every
That's
year.
not the case.
It's
What?
not the case. It's not the case, you know. So, but you don't learn that without that. Like, you know, how many people, you know, I've gotten money from people over the years, and they've been like, I've gotten questions like, "What's wrong?" And I'm like, "What are you talking
Mhm.
about?" "Well, you didn't make money in the 2 months since I gave you your money." What? You know, like that's of course, like that's very normal, that can happen. And
Yeah.
you know, like that there's nothing wrong with that. The point is,
Mm.
especially like my strategy and what I try to explain is I'm trying to not lose much money, sit, and wait for the right opportunities to happen. Not even that I'm sitting there flat. It's just sometimes there is no outliers at that moment. And
Yeah.
sometimes, especially right now, we're chopping around quite a bit, so we want to just be protecting our money, risk manage well, and be ready for that. And I think that a lot of people, they when they don't do that market history and they don't really read the books, they don't see that there are, every trader will have a down year. Every trader, like, I don't know one trader that didn't have a down year. I don't know one trader that doesn't have bad periods or losing streaks or so on. And two things from that: one is, you can give yourself a break. Like, you can give yourself a break of trying to be perfect all the time. Like, it's impossible to be perfect all the time in this business. And
Yeah.
then two is, you can start to really grasp like what you want to do, what you can gain from it, your trading style. If you're not going through history and kind of figuring out, because I know for me, my trading style is a mix of many traders. I grab little things from everybody, going, I mean, starting at, read through Market Wizards, just go from there. It's a great at this point, it is a fantastic history lesson, and especially
Sure.
this type of market. I went back recently and read, Market Wizards 1 again. I was like, man, it's really cool to read that right now, as we're kind of it was a couple years ago where we're redoing this commodity bull thing, and we're
Yeah.
talking to these commodity bulls back then, and that's
Yeah.
super cool. And then going through Reminiscence of a Stock Operator, if you've never read that, that is the ultimate book of the struggle of a trader.
Agreed.
You learn
Agreed.
all of the struggles. You learn the part about him having his own ideas,
Mm.
because I fully believe that a trader who has a great strategy, a great system, can be wrong on the market a lot and still make money, rather than a trader who's going around, like in his book, and he had these ideas and he had somebody telling him what to do a couple times, and he would take their idea and he'd lose money every time. And it's because
Yep.
you don't have any conviction in that, and like he says in the book, is, if I'm taking a tip from even me, if you guys are taking a tip from me and you're reading what I put out, and you're going, okay, Jason is long on sugar right now, and let's say, and then you're going to wait for Jason to be out of sugar.
Mm.
Maybe Jason's not going to post anything about it because he just is going to forget, like, it can be that simple, and really, like, so what I try to do here more than anything is show people how they're going to build their own strategy, build their own ideas,
Yeah.
create their own methodology.
Yeah.
Because at the end of the day, that's all you're going to pay attention to. I could go out and put out, my strategies and my systems and all of these things right on the wall, or a billboard, take out a billboard for everybody to see, and I'm sure nobody would use it. And if they did, they wouldn't make money on it, most likely.
Yeah. Yeah, no, it's true. And a couple thoughts on that. I think that's great. You mentioned earlier about being patient or waiting, right? And so, like, waiting for the right spot. Just maybe there isn't a good outlier. I think it's super unfortunate that when people think trading, they think that means you're actually taking action, right? If I'm trading, that means I'm pulling the trigger at any given moment. Successful traders I've worked with, they sit on their hands sometimes and they just wait, and it's just not the right time. And I think investors get into a lot of trouble just feeling like if they can do something, it's sort of like the GPS tells you have a lot of traffic, so you go some weird side way, and even though it's going to take you longer, you just feel like you want to make progress. I think a lot of times traders and investors just make a trade just to feel like they're able to do something, feel like they have a sense of it. When you have to remember is, if you're doing it right, there should be a time when the market tells you wait, and just hold on and be patient and wait for the right opportunity. And it's so funny. I'm telling my 7-year-old son, wait for the good pitch and, wait for the right opportunity. But as investors, we just completely have grown out of that very sensible way of approaching things. The other thing I would say is, you mentioned just how we get into a lot of bad habits. And I think certainly for investors thinking about 2021 to 2022, I think for a lot of people was a wake-up call of sorts, because when the market's going well, in a bull market phase in general, I mean, the biggest drawdown we had in 2021 was probably 5%, maybe, right? Or around that. So when you have that sort of environment where you just keep buying on the dips and everything works, everyone's a genius. Everyone feels like a rock star. Everyone's process is perfect. There are no issues. And as a result, all sorts of bad habits are there. You just don't recognize them because everything is kind of working. In 2022, all of a sudden, it felt like the market was really difficult, which it was. But I think that was compounded by the fact that everyone's bad habits all of a sudden became a huge liability. and you couldn't get away with not having good routines and not having good awareness and not having good risk management. Whereas in 2021, you probably could have gotten away with all of those things, right? And so just when you're flying, you always develop your emergency strategy when things are going well, right? It's like you're flying straight and level, you're at 3,000 feet, no issues. That's when you're thinking, all right, if the engine cuts out, what do I do, right? What happens if I need to land immediately? Where's a good place? And you're always thinking about that. As investors, as traders, we often don't plan until things start to get rocky. And then it's like, all right, now what do I do? And so I would encourage people, particularly, now in a period of uncertainty, if you have positions that are working and you're sitting on a paper profit, that's when you need to make absolutely sure you are planning for what happens if it turns on a dime and that's the best position I'm in right now. What signal, what line in the sand? I always try to tell people, what are you going to look for that's going to tell you that things are changing, and do it now when things are actually in pretty decent shape for you.
Yeah, and I see that a lot, and even fundamentally, you can have that line in the sand. Like you can
Yeah,
always have that whatever type of trading style you have. So it's important. And I think that the best thing I ever learned is like once my positions are on, I have my stop. I have this. I mean, sometimes volatility changes, and that's something that I've
sure.
always gotten in trouble with over time, especially in futures, is sometimes as volatility changes, you have to
Yeah,
really start to size positions differently and so on.
yeah,
Uh, but you see so many people kind of jump in and go, okay, well, for me, I have my positions on. Let's say I'm long something like coffee. I brought up
mhm,
coffee earlier. I'll just keep bringing it up because why not? So you're long something like coffee. It's very volatile, so
yeah,
your position is going to be smaller. Like that's always very important. I think a lot of people don't understand that if I'm trading something like a penny stock, like it's going to be the small. I don't trade penny stocks, but if I did, that'd
yeah,
be the smallest position ever. Basically. So easy way to put it: natural gas, Bitcoin, some of the most volatile products I trade.
yeah,
And then compared to treasury bonds, especially like a 2-year bond, let's say, extremely not volatile. So a 10% move in the bonds is insane, but a
yeah.
10% move in natural gas or Bitcoin can happen in 20 minutes. It happened
That's right.
the last couple
That's
days,
right.
natural gas
Yeah.
and
It's
Bitcoin.
it's no, it's funny. And I spent a lot of my career working with institutional investors and money managers, and we would spend so much time thinking about risk management, and that meant position sizing. It meant, how unintended bets. So we would look at the portfolio quantitatively, like especially if you're holding things like ETFs. A lot of times, and I find this with individual investors and with traders a lot, you have this unintended bet, right? You're basically making a huge bet on oil prices or on whatever, or you're holding a bunch of ETFs, but each of those ETFs has a huge position in Amazon. So you're basically have an Amazon portfolio. And
Yeah.
instead of buying these 3 ETFs where you think, oh, great, I'm diversified, it's like you have and that one, each of those ETFs is dominated by a couple stocks. And I find that a lot just with the XLY, right? Half of the ETF is 2 or 3 names. And you really need to do your due diligence of thinking about volatility, thinking of exposure, and thinking about what bets you're actually making, because it is often very different than the bet you think you're making. And again, institutional investors are not perfect, but I will tell you they spend a lot of their time understanding the risks that are involved, understanding that they're going to be wrong a lot, and having a really good sense of what is going to tell them that they're wrong, and what being wrong looks like. And I find with individuals, they're often surprised when something happens and they think, well, hold on, this is doing this. Why is my portfolio down? And it feels like those are very correctable issues
Yeah.
if you just do the due diligence ahead of time.
Yeah, and risk management is the most important thing wherever
Mm,
to talk about in trading. I also I believe that a good trader with a good system can make money. I also believe that somebody that has really tight risk management rules and knows how to stick to them will do better than just about anything else. And when we're talking about institutions, another thing that's very important is if you are running the institution. Now, as a trader, sometimes I don't get the information of how exactly everything's balanced. But
mm,
as the person who owns the fund, like they should be, if you're balancing it correctly, like for example, great example is the bank that just blew up, like
yep.
we got, a lot of money in VC. Now, venture capital, from the little I know, I'm not a venture capitalist, but I had a friend who was, and he would tell me that basically 1 out of 10 things will make him money. And that will make back the 10, but he's like, also it could be 0. He's like, it's not a perfect science. So you have to take, okay, well, let's say, making an easy number, we'll say $100,000. If you're, just to make it, obviously this isn't a fund size, we're just talking about this to make it an easy number. So if you're doing something like venture capital, let's say you're going to take $5,000 and put it in something like venture capital, because that's going to be your riskiest investment. Maybe you put 10,000 in like, a futures trading portfolio. Maybe, you have another like in like, another 25% in kind of an all-weather portfolio. And then when you're talking about things like Bitcoin, crypto, things that are really, really crazy, maybe that's going to be 1% of your entire fund, and these things are very important, because when you talk to people about that, they're like, wait a minute. So if I have $100,000, I'm going to put $1,000 into Bitcoin. Like, I'm not going to make any money. It's like, no, you have to think about losing money. Like
That's
this,
right.
but this is the truth of it. You have to think about losing money to make money. If you cap that downside, you open up that upside. But if you're sitting there and you're in those drawdowns all the time, like you will not make that money.
It's so, I mean, I always like to call equities, cryptos, all of these risk assets, right? Which is what they are by definition. But I think investors, traders need to think of them that way, right? The whole point is, if you don't want to take on any risk, you can buy a treasury bill and make actually a pretty decent return at the moment, right? It's actually not a bad place to be, probably, given everything that's going on. But it's a relatively risk-free investment, and you have an expected income, and that's kind of it. But if you're doing anything other than that, you are taking on risk, right? Whether it's risk to economic risk, it's geopolitical risk, it's company risk, it's sector risk, it's all the structural risk, all these different things, and you have the opportunity to generate much better returns, but you're taking on additional risk. And I think one of my favorite concepts when I was doing the CMT program, which is sort of a professional technical analysis process. The best concept, the biggest concept I took away was just the idea of risk versus reward, and thinking about that relationship. It's not just what can I make, it's what can I make relative what do I stand to lose, and thinking about, is this a 3-to-1, is it a 1-to-3, what's my upside potential, and what's going to hurt me, and what does that look like, and thinking about that for each of your positions, thinking about that in aggregate. And again, I think the successful traders that I've worked with are the ones that really understand that. If you ask them, they will tell you specifically, yep, here's the bet, here's where I think it's headed, here's my downside, and they will be able to articulate it. The unsuccessful ones, the ones you don't hear from because they're probably not around anymore in trading, they haven't survived, is because they didn't have a good answer to that question. And so if you can't answer that question for a position, unwind it or find a good answer very, very quickly would be my suggestion.
Yeah, and so a simple strategy that the way to explain this easily would be, once again, we use $100,000 concept. If you have your positions, let's say you're in something like Bitcoin, and you have a stop loss on this, so you use something like $3,000 in it. Your stop loss is $1,000, so that's 1% of your overall portfolio. And your goal and your average, let's say, whether you back test it, however you're going to do this, your average goal is to do $5,000. Gain 5,000. Now, that's a pretty big trade. Well, not that crazy for Bitcoin, honestly, but very possible for Bitcoin. But you're looking for to make 5x of that $1,000 loss. That way you can be wrong 5 times, make your money back, and so on. And so you have to kind of understand those concepts, or you will blow up. Because that's the thing. People don't really put that into perspective, because you're going to lose. You have to. And losing, what we're talking about here, what I just said, is losing 5 times in a row and the next one winning and still being okay. And that's how you have to think of this, because it's not a thing where we're going to put money in and it's always going to work. We study this, we work on this, but the biggest thing we do here is risk management, understanding that if we're looking at this flag pattern, maybe when it breaks that flag pattern, we're going to be done with that trade. Maybe if you're systematic, you have a neutral part of a trade, you're looking for a high to buy, you're selling on a certain low to buy. Whatever you do, however you do it, it doesn't matter, but it's having that same risk management over and over again, which is what makes you money. And whether it's Warren Buffett or whoever, everybody has risk management, like in their fund. There's not one fund I've ever talked to. I mean, I have talked to a couple, but they're gone. They don't exist anymore. But when you talk
Right.
to people, it's all about risk management, because that, what like we talked about, you will have, like, if you have 10 different strategies running, and even if you're a normal person, you should have a few different things, like we talked about treasury bonds. Fine, you go put some money in treasury bonds, then you have your trading portfolio, then you have your retirement portfolio, then you have whatever you want, gold, silver, I don't know, but figure it out, diversify in some form of way. And that
Yeah.
also, to me, that's a big piece of it, because it gives me peace of mind. I don't
Yeah.
want to think that everything is based on my trading. That's a
Yeah.
lot of stress to put on, and nobody trades well when they're stressed either.
No, I would say the mental state is incredibly important. And in general, there's a bravado to trading, to investing. There's an overconfidence that's kind of natural. People go into it, as you alluded to, expecting to be right pretty much all the time and not expecting to be wrong. The market, as you and I both know, is incredibly humbling. I mean, this is a humbling activity that we are engaged in. But I've always, I think you have to realize that losing trades aren't unsuccessful there. I would say if if the market goes against you and your stop loss is triggered. I just had someone recently where this has been a challenging year and a half, I mean, by any stretch. And I
Yes.
had someone that we talked about sort of a good strategy, and then they had a couple trades that didn't work out, probably 2 or 3 in a row, and they came to me, they're like, all right, can you help me figure out what's going on? I'm like, you're good, like, just don't change that. It's like that. The fact that your stops are hit doesn't mean like you're wrong all the time. That means you have a really good risk man. Like, that's great money management. You have to assume that it's not like you're going to be right all the time. And if you're not, then the stop hits. Investing means you're putting bets on. Some of them will work, and you want to make sure that you stick with those. And the ones that don't, you unwind them quickly. And it's not about being right all the time. It's about admitting when you're wrong, which as humans is very difficult for us to do because we have fragile egos. But as successful traders, as successful investors, I think you have to be able to do that. And so have a good natural process where you reflect and review on your successes and also things that didn't go well. One of my former bosses always used to ask, when someone was having a tough run of performance, what did you learn and what are you going to do differently? And sometimes it was like, this is what happened. The conditions changed. I still think my process is good, and here's how I'm going to maybe tweak it. Sometimes it was, all right, this is how I went about it. This is not the right time for it. I need to try a different tact. I've been betting on XYZ, and it's not really the right time for it. But having if you ignore that, which is what people like to do, they like to, when you have a bad experience, just kind of move on from it, mentally push it away and sort of move on to something else. Those are your best learning experiences, right? Ask any successful trader. They will tell you those early losses, which were formative, where they really learned the game of trading and learned painful lessons. You need to have some of those, and don't miss the opportunity to learn as much as you can from them.
Yeah. And I think there's that one quote, if I can remember it. It's by Larry Height. There's good bets and bad bets, and there's good bets where you make money, good bets where you lose money, bad bets where you make money, bad bets where you lose money. And it's
Yeah.
meaning that there's plenty of trade. If I basically look at a good trade today and it meets my criteria completely to put it on, and I put on this trade and it still loses money, that's okay. Like, if it hits the
Yeah.
stop, and that's totally fine. And I think
Yeah.
so many people kind of get stuck in that, like, oh my gosh, I put on this trade and it lost money, and and trust me, it's demoralizing. I was just
Yeah.
talking
It's
about
not
it.
fun
Yeah.
necessarily.
Yeah, yeah, it's not fun for anybody. Over time,
Yeah.
I just get better at it. I was talking the other day about cocoa, for example. I have a cocoa trade that's finally doing well. There's 15 bad trades, 15 stops before that one trade went well. So I got fake signal, fake signal, fake signal, and that
Yeah.
happens, like,
Yep.
and it's why as a macro trader or futures trader, I will trade so many different markets, because the point of it is to smooth your returns, diversify, and try to find those outliers. So you will have, once in a while, you will have something that just drives you nuts. I think the best thing I ever did was I got to read, it was a study from, gosh, it was a very old trend following firm. I can't remember, it was one of the first ones, and they had a study of them trading, I think it was the yen, and I think it was in the 70s, or it was early 80s, 70s, something like that. And anyways, same type of thing. It was a streak of like 40, 50 trades, just bink, 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 it's just completely wrong over and over and over and over again. And then, there's the one trade where they make, quintuple what they lost, because we're talking about the small loss, small loss, small loss. And then, sometimes, because when we're saying something like, hey, that made 5% of the portfolio, made $5,000. There's also plenty of trades that do much better than that, especially for what I do, because I'm basically going to sit in that trade and ride that trade and move my stop up. So sometimes there's trades that make 100% of the portfolio. It's rare, but it does happen. So I don't know if that could be Coco, but this one trade made all my losses back so far. So that's also important to understand, so you can kind of keep taking the shots. Like it's once again, you're not gonna make a shot. If you're playing basketball and you won't shoot at the basket, you're not gonna make a shot if you don't do that. You have to take the shots. And I've met plenty of people who get, and just like you were talking about, somebody who tried 3 times, they're like, oh crap, I'm terrible at this.
Yeah.
Plenty of people who are like gun shy forever, and I think there's also and this is an actual psychological aspect of this that you might learn a little bit or know a little bit about, and could help me understand a bit more, which is, I was talking to a friend the other day, and we're talking about the energy trade, and every single person I've ever met who traded energy, in 2008 to 2019, they all hate it. They will not touch it. They're mad about it. Like, they're like, I can't, it won't work. There's better trades, and it was a great trade, and there was a lot of great trades in the last few years, short and long. And I feel like there's almost, there's a word for it. You might know elasticity, where it's basically something that sits in your brain and kind of creates this narrative over and over again to yourself that you can't do that again, because it's this pain that kind of comes, that's almost trauma that kind of comes to you over and over again when you look at
it what it reminds me of is just the whole concept of anchoring, which is a common issue. And we can anchor to ideas, we can anchor to price levels, but once you anchor to an idea, it's really hard to get disconnected from that. And that happens a lot of time. One of the common anchors you run into is your entry point, right? Is a particular price level, and all of a sudden, all the decisions you make from that point on is because of that starting point. You sort of primed your thinking. And it's really hard to get disconnected from that, but it's arguably one of the most important things to do, because the market doesn't care what idea you're anchored to, right? It does not even matter if you're worried or excited or nervous. It's going to do what it does. And so it's on you to recognize that, and to have a process that allows you to disconnect from those anchors and minimize those biases, and just focus on what's actually happening. And again, it's much easier said than done. And I wish I could tell you, having studied behavioral finance and technical analysis for a couple decades now, that at some point you've just studied it enough that it stops happening. But I still catch it on decisions I'm making. I'm like, yep, of course that's what I'm doing. It's confirmation bias, right? I'm already thinking Bitcoin's going up, and I'm just trying to like find reasons why that should happen, as opposed to don't even think about that. Just gather the evidence and do more of a weight of the evidence approach, which I think is far superior for sure.
Yeah, and I think about it because I learn a lot about my brain over time, and I kind of learn about like learned trauma, basically. And then there's a new theory that's come out recently, which is about the fact that like maybe your parents have handed down trauma to you without knowing it, like from their life to your life, or even grandparents and so on. And so it's kind of like I do see this, especially like it's kind of funny because I do have a friend that has a family that went through the 87 crash and lost everything, and they have this crazy bearish bias all the time. Everything is bearish. They're always bearish. No, you can't say anything and it's bearish, and it's kind of crazy. And it's like, wait a minute, like when he started trading, like the market was just this bull run, and like I don't understand. But once again, it's that kind of like that's almost handed down. And even if it's not that, it's something he's probably heard a million times in his head. And so like we lost everything in 87, we lost everything in 87. So every time the market like ticks down a little bit, he's like, oh, that's it, it's crash, like
right.
And basically he'll be very loud when we're in the environment where he's doing very well, which when it's going down, he's talking all about it every single day. But as he's going up, every spook is I got to short everything. This is the end of the world. Like,
so we would joke. I would joke with people about when you started in the industry, when you started trading, what that environment was like. And a lot of times that would cloud your thinking. So at Fidelity, one of my analysts started in the industry in 1982. So it was literally the 1982 low. This is right before the Dow broke above 1,000 and then never looked back. The 1983 breakout. And so he was always bullish. I mean, he was just bullish on life. He was bullish on the markets. And it was just like, things go. It's like he learned technical analysis when everything was working. I started in the industry in June of 2000, and I moved to New York. And the first year was nightmarish. I mean, it was 9/11. It was the tech bubble popping. All of that happened. So I struggle in bull markets to disconnect from that bearish mentality. I mean, I tend to approach from a seat of caution and wariness because I'm thinking, all right, it's not going to last. This is what tops look like. And that served me well in like 2007 when I saw lots of conditions that looked very toppy. It absolutely killed me in 2013 when I remember going to the head of our desk and saying, market's going down, we're testing the highs again. It's a classic setup. And we just blew right past it. I mean, just didn't even look back and just kept going higher. So, you know, it's tough to disconnect from those, but I think having a good self-awareness and recognizing your own, you know, mental state and some of your own issues and how you approach them or what the baggage you're bringing with you can be really helpful. Not recognizing it, not admitting it is when you get into trouble.
Yeah, and like you said, like you know it. Like that's like, if you know it, that's a whole different thing where you like he my friend does not, you know, and that's okay, but because he doesn't, that's when you get into trouble. But if you know it at the very like Druckenmiller would always talk about it, you know, I have a bearish bias, I have a bearish bias. And really like the guy makes money in all different types of markets, so obviously he's not short all the time.
He's figured it out, I guess.
Yeah, he's figured it out, but he just knows he has it. And it's I think, you know, the best thing I ever kind of learned was I'm glad I took Larry Williams, learned a lot from him, just taking his stuff. Kind of the understanding that like what he had was that crap happens and markets can wipe out everything in minutes, you know. But at the same time, you have to understand that most of the time you're going to want to be on this other side that's a bullish side, because I had a bearish bias too. And so even though, you know, to this day, I still like I can, you know, I'm very nimble and the systems go any which way I want them to go. That's fine. But I try to stick on the idea that markets can go up a lot more than I'm thinking most of the time because of that bias that I have, that when I'm kind of sitting there on that fence, I'm probably bullish because I know what my brain wants to do.
Well, and you have to remember, right, if you're specifically in the equity markets, if you're short, that's okay on a limited basis. But if you're short something long term, you are fighting hundreds of years of market history, which in general because the world's growing and there are more people and the economy is growing over time. And that is sort of the general trend of the human race, at least from history and for the foreseeable future. And until that changes, you're really fighting you're fighting a major league headwind. So when people talk about inverse ETFs and things like that, I think they have a use on a limited basis when you understand the risks for sure, but when you think about the time frame and recognizing the time frame that you're operating on relative to the longer term cycle, I think that's what someone like Larry Williams really does well about recognizing, and I think people should certainly focus on that if they're unfamiliar.
Yeah, and that's you know, another thing we kind of chat on, which is time frames, you know, in general, how important that is just to understand what everybody is talking about. Like for me, I'm a primarily a position trader. You know, I mainly trade pretty long term, you know, we're talking 6 months to a year. Most of my ideas are going to be within that time frame. So when you have somebody who's, you know, people go on Twitter or they go on this or they go on that and they see somebody saying I'm bearish, I'm bullish, and you don't like there's a guy who's bearish and bullish every single day, but he's a day trader, you know, like he has a little range he puts out and he's a very good trader, but that's the point. And you know, you have to understand somebody's time frame before you understand what they're talking about, because there's so many people who are like, oh man, I can't believe you're bullish, I can't believe you're bearish. For me, even like, you know, recently I was talking about being pretty bullish. I'm having, you know, most of my indicators are telling me that I should be bullish for this time frame. You know, basically you know, last week happens, you know, I think I put this thing out on Wednesday, and then Friday happens and I'm getting a bunch of messages, oh my god, I can't believe you're bullish, you know, it doesn't make sense. And it's like I'm not not sitting, like for me, that doesn't change my outlook. That
Yeah.
doesn't change my positions. That doesn't
Yep.
change what I'm doing. For somebody else, that could be, their $1 million trade. They're very short term. They got a big short on the banks or something. Great, but that's just not me.
Mm.
So we have to always understand everybody's time frame and kind of chat that through a bit. I think that's another thing a lot of us in general, and that's not something anybody's in charge of. If you're just reading what somebody's saying, like obviously they're not in charge to tell you their perfect time frame, but
Yeah.
really, like, it's something that's very important to understand.
Well, and I think thinking in multiple timeframes can be really, really helpful. My suggestion to people is think
Yes.
about, I mean, you had a great answer for like, this is what I'm trying to do. I'm a position trader. This is what my general time frame I'm operating on. That can change, right? If market conditions are shorter or longer, that certainly can evolve, but you need to have a sense of what your sort of investment horizon kind of is. And I find a lot of people don't. They just sort of are winging it in terms of timing. I tend to be looking out about 1 to 3 months on average. And so that's kind of my sweet spot. Like that's where I'm trying to operate. But what that also means is I recognize there's a larger time frame, like a 1 year plus kind of business cycle, economic cycle time frame. So the moves I'm trying to capture are probably part of this much bigger thing. And I also have to remember that the 1 to 3 month moves that I'm looking at are also comprised of smaller moves, and that's sort of the fractal nature of the market. So I always think about the time frame I'm trying to operate on, and then one larger and one shorter, and recognizing where I'm at right at this moment, ideally, versus that shorter time frame in the longer term, and thinking about how they're related can be really helpful. The good thing about technical analysis is you can easily accomplish that by looking at two things: different time frames of your chart. So looking at weekly and monthly charts, daily charts, hourly, 5-minute charts. I mean, you can scale that. You can use indicators and scale them, make them shorter or longer term time. Look at longer term moving averages. Look at shorter term RSI or a longer term RSI. And any of those adjustments just allow you to think about a little bigger, a little smaller. But just having one thing and thinking that's the trade, I think you're missing the benefit of recognizing the relationship, because a lot of times there's big money that's operating on those other timeframes, and they will impact the trade that you're trying to make for sure.
Absolutely. So when I'm looking at something, and that's a great point. So when I'm looking at something, I want to know what risk is immediate. And
Yeah.
because of that, I want to look at the shorter term time frame. So that 3-month time frame, or even 1 month to 3 month, like you're talking about. Then I
Yeah.
want to look at like maybe something that's a little bit longer than that. Maybe that 4-month time frame, 5 months, 6 months. And so I'm going to look at that and see, okay, and then maybe I'm going to set up my big trades based on that, because really you have to understand what risk is coming your way. In the immediate future, when I'm talked about and what I put out initially was, yes, I am long-term bullish. In the very short term, there is a lot of volatility that can come into play. Be
Yeah.
cautious, because we have the VIX got very low. And it didn't pop. And for some reason, the market was going down and the VIX wasn't going anywhere. That's usually a pretty bad sign from time to time.
Yep.
And so we had that situation kind of coming up. Boom, here it is. For some reason, all of my signals that are on that longer term 1 year time frame are pretty bullish. Now, I don't know what the catalyst is for that most of the time. I could tell, if you're looking at you look at relative strength too. So if
Yep.
we're looking at things like relative strength and we're looking at all these things, the market's kind of saying a story of bullishness. But the fundamentals, the the short-term technicals, everything else is telling another story. So you
Yeah.
have to kind of be open to this short-term time frame that has this possible action in it, and then the long-term time frame, which is always subject to change.
Yeah.
Because as you get further out, though, it's just like options are priced. The further out you are, the more volatility that can come into play.
Yep. And I find that especially with things like the Fed meeting coming up next week, and I'll get asked, what do what does the market do around the Fed meeting? It's like, well, like, are we talking about just at the moment? Because that's one set of things, is like the short-term implication, right? He's in a press conference right now, and we've seen what's happened in the last, 4 or 5 meetings. It's been, like syllable by syllable, the market's jumping up and down, hanging on every little nuance of what he's saying. But there's also the longer term, like the forest for the trees, about what does this particular meeting mean relative to this trajectory that we're on, and where's the finish line of the rate hike cycle, the tightening cycle that we're in. And so again, I think with most things, we get caught very much in a particular time frame, a particular narrative. And what you have to remember is there's this interplay of different timeframes, and recognizing, what the short term versus long term, and even like a medium term implication of things. Make sure you're thinking of that on any macro item, an inflation number, an earnings release. There's the short term reaction, but then quickly that reverts to more of the long term. And you see that with earnings all the time, right? There's an initial reaction to earnings, but then we go right back to where, and it was just a quick, gut check on what was happening, but then we're kind of back to the bigger themes. And don't forget that those are related, but they're different.
Mm-hmm. Yeah, and you were looking at, right now we're kind of looking at these commodities that are kind of holding up pretty well, like we're looking at the currencies overseas, especially Europe, which Europe was supposedly going to destroy itself through inflation and natural gas like last year, and now Europe's kind of bottoming out. The bonds in these countries are also doing well. All these things that are kind of coming together and kind of giving us this pretty picture of what's going on in the world,
Yeah.
as opposed to what's on the news at the moment. And when you have something shocking like this bank situation and it goes boom, and then it gets bought up, for me, there's nothing more bullet. Like, perfect example, that bottom in October was the most telling bottom I've ever seen in my life. You have that breakdown, this panic worldwide. Everybody's scared. It was a CPI number day or something, I think. I'm not sure. Yeah.
Yep,
So,
right at the low.
yep. So boom, it comes down, it breaks to a new low. We're headed to a new low, and then it goes right the other direction, and that was the bottom. And there's so much information in that. Like, that's something that I think people don't look at when they're looking at technical analysis, to understand that that's information. When you have something break down and then it drives right back up, that's telling you that news got discounted very quickly, that panic set in, all these sellers started panicking, and who was left to sell? There wasn't many. Not at that level, at least. So boom, they end up going the other direction. That was the bottom to this day at the moment.
And what's so funny is if you look at the charts in October, and it happened on the S&P, it happened on the Qs, happened in a bunch of individual names. You have technically you have what's called a bullish engulfing pattern, or bullish outside day, or some sort of positive rotation. And again, it doesn't truly matter what the economic number was. Like, was it CPI? Like, it doesn't matter. What the chart is telling you is we gapped down at the open, meaning there was a reset, there was a change in valuation, but then immediately buyers came in, right? That was the low. And so by the end of the day, I mean, a lot of the charts we look at just had these big, changes, intraday reversal, opening low, closing very high. I think that tells you all you need to know about the sentiment right there. The price gap's down. There are a bunch of willing buyers coming in and pushing it up. And it could be short covering, could be a bunch of different things, but there's more demand than supply, and the price is moving higher. And so, I would argue there were a bunch of different things around that period. Improvement, breadth conditions that were incredibly bombed out that all of a sudden started to improve. There were a lot of conformational moves after the low that sort of validated that. So I think recognizing that is so helpful. And again, another reminder to pay attention to market history, go back and learn the lessons there.
Yes, absolutely. And I think that's the biggest point of, I think, what we're all saying here today, which is the constant reminder to understand market history, not be wed to any ideas, and really, like, understand what the charts are trying to tell you sometimes. Because last week, if we look at that situation, and you had all the panic in the world, and people always go back, they fight the last war. And they go back to 2008. They're like, that's it. The banks, that's it. This is all going to fall apart. It's going to be just like 2008. And it's like, do you forget what caused that crisis? Like, is it the same thing? Like, probably not at all even, but once again, everybody's fighting the last war. And once again, I could be wrong on that. I might have been wrong, but the market's telling me that I'm right on that point, and that's what we want to, that's really what we want to see. I have this speculation, I have this idea, I'm reading the charts and so on, but the price action on those days tell me a lot more than I could ever dream of. So as long as I'm able to, Friday, for example, was a good, you have oil up, which was odd in that day. Like, oil and regional banks are very tied in together for many reasons. And then you have, oil going up, and you're like, what? You have gold, skyrocketing, the bonds kind of giving this panic reversal almost, kind of saying something. So you have all these things kind of going at once, and that's kind of saying something, but that's one day.
Yeah.
Now we're getting into this week and it's kind of continuing. So this is all really, to me, saying something. Looks like growth stocks are saying something. Looks like, the tech sector is saying something. So if we got all of those things kind of together, it's kind of going, okay, well, we're back up and over these 200-day moving averages. People do look at those, whether they pretend they don't or not. And so here we are, are we going back into an uptrend, which is very possible. We're in a very bullish period of the year historically, end of
Yeah.
March into April. So we'll see where we're going. So we could end on that. Where do you think what are you seeing right now in the markets?
No, I think that's great, Jason. I would say that just to add to that, seasonally it tends to be strong, but particularly in a pre-election year, which is where we're at. I mean, if you look back at the 4-year presidential cycle, what usually happens is you bottom around October of the midterm election year, which we did, and then the first half of this year, actually, the pre-election year tends to be pretty strong. So we're actually following that 4-year cycle pretty brilliantly so far in 2023. I think the most encouraging thing is the strength in technology, particularly the strength in semiconductors. That's the backbone of the modern economy. The charts look good, right? I mean, look at AMD, look at NVIDIA. These are decent charts. They're not breaking down. They're in good, good technical patterns, strong price, improving momentum, but not excessive, strong relative strength. And those are the areas of the market that if things are okay, those are doing pretty well. So while I think there's certainly some risks around there, and I think what we learned in the last week is there are the 5, 6, 7 standard deviation events that you don't think would normally happen that just pop. I mean, I did not think a week ago we would have a bank failure that we'd be talking about, but that is what investing is like, is you have these one-off events that are just surprises. But if you look at what the ripple effects have been overall, it's still a position of strength. And while some stocks certainly have broken down, the average stock is holding up pretty well. So I'm inclined to follow that trend until proven otherwise. And for me, it's suggesting, positive over negative for now.
Yeah, for now. And that's the best way to put it.
That's right.
Looking at this, it's always data dependent. We're always data dependent, and it's always over time. And that doesn't mean it's wishy-washy. That means that we're sitting there and taking it in all the time and understanding that overall the number one important thing is what we talk about today: risk management. So that's the most important thing. Like, not what we think, but if the charts switch and they're saying something and we're chartists, we're gonna switch.
That's exactly right. And I would encourage people to think about different probabilities, right? You instead of getting tied into a narrative, I'm bullish, so I'm owning a bunch of things and then I'm done. You think about probabilities. There's a chance that the market goes higher and the S&P goes to 5,000 by the end of the year. I don't think that's likely, but it's a possibility. There's a chance the S&P goes down to 3,000 in the next 6 months. Also, I don't know if that's the most likely outcome, but it's a possibility. And there are a lot of possibilities in between. And so thinking about those different outcomes, what they look at, particularly from the angle of risk management, I think it'd be a really healthy exercise right about now in a period of uncertainty.
Very smart. All right, David. Well, it was great to have you on. Thank you so much for doing this. It was a blast. I had a lot of fun. I learned a lot, and we'll talk soon.
It was great, Jason. Thanks again.